Welcome back to the Deep Dive, everybody. We have a really fascinating topic today. And, we love getting all this material from you guys. And lately, we've been seeing a lot of interest in really trying to unpack some of those terms that can cause a bit of anxiety for investors, especially terms like bear markets and corrections.
Yeah.
So today, we're going to really try to dig into those, figure out what those terms actually mean, how they differ from one another, and most importantly, give you the tools and the knowledge to navigate those periods without feeling completely lost and overwhelmed by all the financial jargon that's out there.
Right.
And thankfully, we've got a really great collection of articles and research materials here that lay out these concepts in a really accessible way. So let's just jump right in.
Sounds good.
All right, so let's get down to brass tacks here. When we hear the term bear market thrown around, what exactly are we talking about?
So when we talk about a bear market, we're essentially referring to a sustained decline of 20% or more from a recent peak in a major market index. And, you mentioned the S&P 500 earlier. That tends to be the benchmark most often cited when we're talking about these broad market movements. It's important to note that this isn't just like a blip on the radar, right? This is not just a few bad days of trading. It really signals a much more significant and prolonged downturn.
Got it. So that 20% drop, that's like the line in the sand.
Exactly.
But then we also hear about this term correction. So how does a correction differ from a bear market?
Okay, so a correction is also a drop in the market, but it's definitely less severe than a full-blown bear market.
Okay.
And we typically see those in the range of 10% to just under 20%.
Gotcha.
So think of it as a pullback, but not quite that full-on retreat like we see in a bear market.
So 10 to just under 20 is a correction. We hit that 20% or more, we are officially in bear territory. And that seems like a really important distinction because it can completely change how someone might think about and react to what's going on with their investments.
Yeah, absolutely. And how you interpret that market volatility can have a huge impact on your decisions.
For sure.
If you see a correction, maybe you have one strategy versus a bear market where you really need to think, okay, this is the real deal.
Exactly.
Yeah.
Now, I think a lot of people hear these terms, they see these headlines, and they wonder what actually causes these big market shifts? And what does it really mean for, my financial picture? So let's delve into that a little bit. What are some of the primary causes behind these bear markets?
Taxes stressing you out? Don't worry, 1-800-ACCOUNTANT is here. Expert help, affordable rates. Call 1-800-ACCOUNTANT today and leave the headaches to the tax pros. Click the link below.
It's interesting because I think a lot of times when we think about bear markets, we try to pinpoint one single cause.
Right.
But it's rarely that simple.
Right.
It's usually a combination of things that kind of converge and create this perfect storm. But I think one major factor that a lot of your sources probably touch on is the idea of an economic recession. So when the overall economy contracts significantly, corporate earnings tend to decline. And that obviously has a big impact on investor confidence, right?
Yeah, that makes perfect sense. If the businesses aren't doing well, if they're not generating as much revenue, then obviously that's going to put downward pressure on their stock prices.
Right. Exactly.
So besides a recession, what else could trigger a bear market?
So another big one is rising interest rates. When the cost of borrowing goes up for both businesses and consumers, that can actually slow down economic growth. And when things start to slow down, investors tend to get a little bit more cautious, and that can lead to market declines.
Right, kind of puts the brakes on everything a little bit.
Exactly.
Now, I would imagine that global events can also play a role in all of this.
Absolutely. Geopolitical events like wars, significant political instability, things like that in key regions around the world, they can really inject a lot of uncertainty into the markets. And, markets generally hate uncertainty.
Right.
So you'll often see that these types of events trigger these broad sell-offs where investors are seeking, a safer place for their money.
Right. They want to go to a safe haven.
Exactly.
Now, what about those situations where you see asset prices just climbing and climbing, sometimes without a clear reason? We've all heard this term asset bubbles. So what are those all about, and how do they relate to bear markets?
Yeah, asset bubbles are definitely another potential trigger for a downturn. This happens when the prices of assets, things like stocks or real estate, surge to levels that aren't really justified by their underlying value.
Right.
And so you get this bubble, and eventually that bubble bursts.
Yeah.
And when it does, you can see pretty sharp corrections or even the start of a full-blown bear market because investors realize, wait a minute, these prices were completely unsustainable.
Right. It's all based on hype, and eventually that hype dies down.
Yeah, exactly. And a great example of that is, the dot-com bubble back in the late 1990s.
Right,
You saw internet company prices just soaring. A lot of them weren't even making any profit.
right.
And when that reality set in, the market took a pretty significant hit.
Right, it all came crashing down.
Exactly.
So it's not always just about these cold, hard economic numbers, right?
Yeah.
Investor psychology seems like it plays a huge role.
Yeah, psychology's huge. Fear and panic can really accelerate market declines.
Right.
Because if enough investors get worried and they start selling their holdings, it creates the self-fulfilling prophecy.
Wow.
And prices go down even further, which then scares more people into selling, and so on and so forth.
Yeah, it's like a snowball effect almost.
Exactly.
So, besides that key 20% drop that we talked about, what are some other telltale signs that we might be entering a bear market?
Okay, so there are a few things to watch out for. One is declining trading volume. When investors are unsure about the future, you often see less activity in the market overall.
So people are kind of pulling back a bit.
Yeah, they're being a little bit more hesitant.
Right.
Another one, and we talked about this before, is falling corporate earnings.
Uh-huh.
Because companies are typically going to report lower profits during those economic slowdowns.
Right.
And that just reinforces that negative sentiment in the market.
Yeah, it just adds fuel to the fire.
Exactly.
Now, what about when the market just seems to be swinging wildly from day to day?
So yeah, that increased volatility, those really big daily swings, those are often a hallmark of a bear market.
Okay.
Because it reflects that uncertainty, that struggle to find a stable footing.
Right.
And then finally, I would say pay attention to the overall news sentiment.
Uh-huh.
Because during a bear market, you're going to see a lot more negative media coverage and just a more pessimistic outlook from investors in general.
Got it. Okay, so we've talked about what defines a bear market and a correction, some of the things that can trigger them, and also some of the warning signs to watch out for. Let's get real here. Let's talk about the impact of a bear market. How does it affect individuals and the broader economy?
Right. Well, I think the most immediate impact, at least for investors, is the decline in their portfolio values.
Yeah.
Right? When stock prices drop, obviously the value of your investments goes down. And this can be especially concerning for people who are nearing retirement or those who have shorter-term investment goals.
Right. You're not looking at a 20 or 30-year horizon at that point.
Exactly.
It's much more immediate.
Yeah.
Trade in your boring job for a brilliant career using Adobe Creative Cloud. Start learning now with the free trial link in the description.
And then beyond just the individual investor, you have the potential for decreased consumer spending. Because if people see their accounts shrinking, they get a little less confident about their financial future.
Yeah, they're a little bit more hesitant to pull out the wallet.
Exactly. And that can spill over into the economy as a whole.
Absolutely. And it's not just individuals, right? Businesses are also affected.
Yeah, absolutely. Businesses see this uncertainty around a bear market, and they tend to become much more cautious as well. They might delay investments, cut back on hiring, just generally become more risk averse. And unfortunately, that can further contribute to that economic slowdown.
It's a vicious cycle, almost.
Yeah, it can be.
And I think we also have to acknowledge that psychological toll that a bear market can have.
Totally.
That stress of seeing your investments lose value, that can really take a toll.
Yeah, it can lead to some really bad decision making. People make emotional choices, and that can really be detrimental to their long-term financial well-being.
Absolutely, they panic.
Exactly.
All right, so let's go back to corrections for a second.
Okay.
We know that they're defined as that 10 to just under 20% decline. But how often do they tend to occur?
They're actually quite common.
Barely.
Yeah, your research probably shows that we've had something like 10 market corrections in the S&P 500 just since the year 2000. And historically, they tend to be pretty short-lived, usually lasting about 3 or 4 months on average.
3 or 4 months, that feels a little bit less scary than potentially years.
Right.
And, term correction itself, it implies that we're kind of getting back on track, right?
Exactly.
So what's the thinking behind that?
Well, the term really reflects this idea that these declines are kind of correcting what might have been an overvaluation in the market. So it's bringing things back to a more reasonable level, more in line with the long-term growth trend. And I think the interesting thing for long-term investors is that corrections can actually create some really good buying opportunities.
Right, you need to buy at a bit of a discount.
Yeah, you get to buy those assets at a more favorable price.
Yeah, classic buy low strategy.
Exactly.
All right, let's dive back into bear markets a little bit more.
Sure.
So we talked about that 20% or greater decline being the definition. And we know that they typically last longer than corrections.
Mhm.
But on average, how long are we talking about?
So historically, the average bear market has lasted about 9.5 months.
Okay.
But it's important to keep in mind that averages can be skewed by outliers. For instance, back in 2020, when the pandemic first hit, we had this super short bear market. It lasted only about a month before the market started to recover.
Well, only a month.
Yeah.
That's really interesting. So when does Wall Street officially declare a bear market over? Like, what's the signal?
So the generally accepted indicator is when the stock market, and this is usually a major index like the S&P 500, when it closes at a new record high.
Okay.
So it surpasses that previous peak, which basically means the market has not only recovered all those losses, but it's actually moved into uncharted territory.
So it's really got to get back above that previous high.
Yeah, exactly.
And just so we're crystal clear here, that entire drop from the market peak down to its lowest point, that whole period is part of the bear market, right?
That's right. The bear market is defined by that peak to trough decline. And then when it starts to climb back up all the way to that new record high, that's what marks the beginning of a new bull market.
Right, the bull market takes over at that point.
Yeah.
Okay, so let's zoom out a bit. Let's talk about these market downturns more broadly, whether it's a correction, a bear market, whatever it may be. What are some of the underlying causes that drive these downturns in general?
Well, at a fundamental level, you have to remember that the market is really driven by the collective actions of all investors. So if there are more people selling than buying, obviously prices are going to go down.
Right, simple supply and demand.
Exactly. And what's interesting is to think about the difference in sentiment between a correction and a bear market. So a correction might be driven by more specific concerns, maybe something happening in a particular sector or a one-time event. But a bear market, that usually signals a broader loss of confidence in the overall economy.
So it's more like a general feeling that things just aren't going so well.
Yeah, exactly. Like people are looking at the future and they're not feeling very optimistic.
Right, the future looks bleak.
Yeah, exactly. And often, a weakening economy or even the anticipation of a slowdown can trigger that kind of pessimism that leads to a bear market.
So it's not even necessarily happening yet, just the thought of it can be enough.
Sometimes, yeah.
Wow.
And then also, we talked about asset bubbles before. Sometimes investors just feel like the market has gotten ahead of itself, that it's overvalued, and that a pullback is inevitable.
And it's almost like a self-fulfilling prophecy, right? Like that negativity then feeds on itself.
Exactly. It becomes this feedback loop where negative signals lead to more selling, which pushes prices down further, and that just erodes confidence even more.
Yes, a downward spiral.
Yeah, it can be tough. Now, we often hear bear market and recession used kind of interchangeably, but what's the actual relationship between those two?
Yeah, I feel like in the public consciousness, they're almost synonymous.
Hmm.
But are they really the same thing?
Well, they often happen around the same time, but it's important to remember that they're distinct phenomena.
Okay.
So a recession has a very specific definition. It's 2 consecutive quarters of decline in a country's gross domestic product, or GDP.
Okay.
And that's basically a measure of the total value of goods and services produced in the economy.
So it's like the economy is officially shrinking.
Exactly.
Okay. So how does that relate to the stock market then?
Right. So the key thing to remember is that the stock market is not a perfect reflection of the economy in real time.
Okay.
The market is forward-looking. It's trying to anticipate future economic conditions.
Got it.
So the stock market can actually start to decline before a recession officially begins.
Oh,
And conversely, it can start to recover before the recession is actually over.
interesting.
So they influence each other, but they're not the same thing.
Okay, so they're connected but not the same.
Exactly.
Okay, so I think a lot of people, when they see the market start to dip, they wonder, okay, is this the beginning of something bigger? Is this correction going to turn into a full-blown bear market? So do corrections always lead to bear markets?
Well, that's the million-dollar question, isn't it?
It is.
And the good news is that historically, most corrections don't turn into bear markets.
Really?
Yeah, it's a bit reassuring.
That is reassuring.
Yeah.
Okay.
Your research might show that since about 1975, only a small handful, like maybe 6 out of 27 market corrections, have actually turned into those more severe bear markets.
So only a small percentage.
Yeah, it's a minority.
Okay, well, that's good to know. But I guess the tricky part is, how do you know in the moment whether it's just a temporary dip or the start of something more serious?
Yeah, that's the challenge.
Yeah,
Predicting where the market's going to go is really one of the hardest parts of investing.
right. Nobody has a crystal ball.
Exactly. There's no foolproof way to know for sure whether a correction's going to deepen into a bear market. It really depends on a lot of factors, the underlying economic conditions, the severity of the initial concerns that sparked the decline, things like that.
Right. It's all very nuanced.
Yeah.
Okay, so let's talk a little bit about some of the historical data surrounding bear markets.
Right.
What kind of losses have we typically seen during these periods?
Okay, so on average, the stock market has experienced a decline of about 35% during a bear market. But it's important to put that number in perspective.
Okay.
Because bull markets, historically, those gains have averaged around 111%.
Wow, that's a huge difference.
It is.
Okay, so how often have we seen these bear markets throughout history?
So since 1928, the S&P 500 has experienced about 27 bear markets. And it's interesting, during that same time period, there have actually been 28 bull markets.
Wow, so basically it's even.
Pretty much, yeah.
Yeah.
And that really emphasizes that the market has this long-term upward trajectory.
Okay, so even though bear markets are reality, the overall trend is still positive.
Exactly.
What about the length of time, the duration? We know that the average is about 9.5 months. Is that pretty consistent?
Yeah, so that average duration, it's about 289 days.
Yeah.
And that's actually shorter than the average bull market. Historically, bull markets have lasted about 965 days.
Okay, so about 2.5 years.
Yeah, about 2.5 years.
Got it.
So those periods of market growth tend to be much longer than those periods of decline.
Okay, so it's good to know that the good times last a bit longer.
Yeah, definitely.
Now, how often should investors expect to encounter these bear markets?
So the long-term average has been about once every 3.5 years.
Okay.
But there has been some variation over time. You know, your sources might point out that between 1928 and the end of World War II, they were more frequent, happening maybe every year and a half or so.
Oh, wow.
But since then, they've been a little bit less frequent, happening maybe every 5 years on average.
Okay, so the frequency can change depending on what's going on in the world.
Exactly.
That's interesting.
Taxes stressing you out? Don't worry, 1-800-ACCOUNTANT is here. Expert help, affordable rates. Call 1-800-ACCOUNTANT today and leave the headaches to the tax pros. Click the link below.
Now, this next stat, this really caught my eye, and it might surprise some people, but a really big chunk of the stock market's strongest single-day gains have actually happened either during a bear market or right at the start of a new bull market.
That's right. It is kind of counterintuitive.
Yeah.
But about 42% of the S&P 500's best trading days over the last 20 years, those happened while the market was still technically in a bear market.
Wow.
And then another 36% of those top performing days, they occurred within the first 2 months of a new bull market.
Okay, so that's almost 80% right there.
It is. And it's right when things are really uncertain.
Right.
Yeah.
Nobody really knows what's going to happen next.
Yeah, exactly.
So that really highlights how difficult it is to try to time the market.
Absolutely.
Because if you pull out during a downturn, you might miss those really big rebound days.
Exactly. Trying to perfectly time the bottom and then get back in, it's nearly impossible.
Right, it's like catching a falling knife.
Yeah, it's really risky. And for most investors, staying invested, even though it can be emotionally challenging, is probably the more prudent strategy in the long run.
Right, you got to stay the course.
Yeah, exactly.
And just to reiterate something we talked about earlier, a bear market doesn't automatically mean that we're headed for a recession, right?
That's right.
Yeah.
You know, they often occur together, but they're not the same thing.
Okay.
Since 1928, we've had 27 bear markets, but only 15 recessions.
Okay.
So a declining stock market doesn't necessarily predict a recession.
So you can have one without the other.
Yeah, exactly.
Got it. So if we're thinking long term, let's say someone's planning to invest for the next 50 years, how many bear markets should they reasonably expect to see?
Well, if you look at that long-term average of about 1 every 3.5 years, someone with a 50-year time horizon could potentially experience something like 14 bear markets.
14. Wow, that sounds like a lot.
It does sound like a lot, but it's important to view them as a normal part of the investing journey.
Right. It's part of the cycle.
Yeah, it's going to happen.
Okay. And overall, the market spends more time going up than going down, right?
Absolutely. Over the last 94 years, bear markets have only made up about 21.4% of that time. So stocks have actually been rising for about 78% of that period.
Okay, so the good times outweigh the bad times.
Definitely.
All right, so I think we have a really solid understanding now of what these terms mean, what causes them, and the historical patterns that we've seen. So let's get practical here. Let's talk about how investors can actually navigate these downturns. What are some strategies to not only survive, but maybe even thrive?
Okay, so one fundamental principle that's always important, but even more so during these volatile periods, is diversification.
Okay.
And that basically means spreading your investments across different asset classes like stocks, bonds, maybe some real estate or commodities.
Okay.
So if one area of the market takes a hit, your whole portfolio isn't completely wiped out.
Right. So don't put all your eggs in one basket. Now, what about that strategy where you consistently invest a fixed amount of money at regular intervals, regardless of what the market's doing?
So that's dollar cost averaging.
Yeah.
And it's a really great tool for dealing with market ups and downs.
Yeah.
Because you're buying a set dollar amount, you end up buying more shares when prices are low and fewer when they're high.
Okay.
And over time, that can actually lower your average cost per share compared to trying to time the market and make one big investment all at once.
Right. So you're kind of smoothing out those bumps along the way.
Exactly. Exactly.
And I think it's really important to maintain that long-term perspective, right?
Absolutely. Bear markets, they're temporary setbacks, you know.
Right.
But historically, the market has always trended upwards in the long run.
Right.
So focus on your long-term goals. Don't panic and make rash decisions based on what's happening in the short term.
So try to ignore the noise.
Yeah, block out the noise. And also focus on investing in high-quality assets.
Okay.
Well-established companies with strong fundamentals.
Right.
Because those are the companies that are going to be able to weather the storms.
Right. The ones that are built to last.
Exactly.
Now, are there any specific types of stocks or sectors that tend to do better during a downturn?
Yeah, there are. They're often called defensive stocks or sectors.
Okay.
And these are industries like utilities, you know, your gas and electric companies.
Right.
Consumer staples, which are the companies that produce essential goods like food, household products.
Okay.
And healthcare.
Okay.
Because people still need those things, even when the economy is struggling.
They still need to eat. They still need to heat their homes.
Exactly.
Exactly. What about having some cash on hand?
Yeah, that's another really good point. Having cash gives you flexibility.
Okay.
It lets you take advantage of buying opportunities when prices are low.
Right. You're ready to pounce.
Yeah,
Yeah.
like that dry powder. And it can also help you avoid having to sell other investments at a loss if you suddenly need cash for something.
Right. So you're not forced to sell at the worst possible time.
Exactly.
Now, you mentioned rebalancing your portfolio earlier. How does that work, especially during a downturn?
Okay, so as different investments in your portfolio go up and down in value, your initial asset allocation, you know, the mix of stocks, bonds, and other things, it can get thrown off balance.
Right.
So rebalancing is basically selling some of the assets that have done well, or at least haven't fallen as much, and using that money to buy more of the things that have declined more.
Okay.
So you're kind of bringing your portfolio back to that target allocation.
Right. You're getting back on track.
Exactly. And it's a disciplined approach that can help you buy low and hopefully benefit when the market recovers.
Right. So it's a long-term strategy.
Yeah.
Now, I think this is really important. It's one thing to stay informed, but how do you stay informed without letting your emotions get the best of you?
Yeah, that's key. Stay informed, but don't panic.
Okay.
It's important to know what's going on, but don't make impulsive decisions based on fear.
Right.
I think studying history can be really helpful here. You know, looking at past bear markets can give you some perspective and remind you that this is normal, it's part of the cycle, and historically, the market has always recovered.
Right. So it's not the end of the world.
Yeah, exactly.
All right. So let's talk about the potential upside here.
Okay.
Yeah. Bear markets, they're not all doom and gloom. What are some of the opportunities that they can create for investors?
Right. Well, this is where that classic buy low, sell high principle really comes into play. Bear markets can create some fantastic buying opportunities for patient investors.
Okay.
Because when you have solid companies with good long-term prospects, but their prices are down because of this broader market fear, that's a chance to get in at a discount.
Right. Capitalize on that fear.
Exactly.
So it really takes, I guess, courage and conviction to buy when everybody else is selling?
Yeah, it does take some guts. You got to be able to look past those negative headlines and really focus on the long term.
Right. Keep your eyes on the prize.
Exactly.
And I think it all comes back to perspective.
Yeah, absolutely.
Remembering that these downturns, they're a normal part of the cycle. They're temporary.
Exactly. They're unsettling, but they're not permanent.
Okay.
Historically, they've always been followed by periods of recovery and growth. So stay focused on your long-term goals, stick to your plan, and you'll get through it.
Right. Stay the course. So just to recap really quickly, a correction is typically that 10 to just under 20% dip, whereas a bear market is that more substantial decline of 20% or more.
Yeah, that's the main difference.
And both can be a little nerve-wracking, but they're both normal parts of the market cycle.
Exactly.
And, even though there's potential for losses in the short term, bear markets have historically been shorter than those periods of growth.
That's right.
And they can create opportunities for long-term investors.
Absolutely.
Now, here's something to ponder, and this kind of ties back to what we talked about earlier. Considering that some of the best days in the stock market have happened either during a bear market or right at the start of a new bull market, how might that knowledge change your perspective on volatility and your investment strategy moving forward?
That's a good question.
Something to think about.
Yeah.
All right, well, thank you so much for joining us today and for sharing your expertise on this really important topic.
You're welcome.
And we hope this is giving you, our listeners, a better understanding of market downturns and maybe even a little bit more confidence in navigating them. So until next time, happy investing, everybody.
Take care.
Bye.